Enron, the illusion that bought the world. December 2001. America's seventh largest company files for bankruptcy. $63 billion vanish on paper. Thousands of employees watch their careers, pensions, and savings evaporate overnight. Wall Street freezes, not because the collapse happened, but because no one can clearly explain how it happened. This wasn't a startup flameout. This wasn't a bad quarter. This wasn't even a recession story. This was Enron, a company that appeared to sell everything, controlled markets, predicted the future, and in reality, sold almost nothing at all. A company that turned confidence into currency, complexity into camouflage, and belief into profit. And when the illusion finally broke, it didn't just destroy itself. It exposed how an entire financial system had learned to clap without understanding the performance. This is the story of Enron. Not just how it collapsed, but how it convinced the world it never could. Origins, a very boring beginning. To understand Enron, you have to start with how aggressively unremarkable it was. In 1985, Enron was formed from the merger of two natural gas pipeline companies, Houston Natural Gas and Internorth. This was not a glamorous industry. Pipelines did not inspire dreams. They moved gas from point A to point B and collected regulated fees for doing so. No innovation, no disruption, no hype. Just infrastructure. The kind of company that accountants understand perfectly and journalists ignore completely. For decades, energy utilities in the United States operated under strict government regulation. Prices were capped, margins were predictable, growth was slow. The entire point of the system was stability, not creativity. Enron, at birth, was exactly that kind of company. Then came Ken Lay. Ken Lay looked like success. Economics PhD, confident posture, polished smile, political connections, and most importantly, a belief that regulation was not protection, it was a prison. Lay believed that if the government stopped telling energy companies what they could charge, energy itself could become a market rather than a utility. Gas would no longer just be pumped, it would be traded, hedged, speculated on, sliced into contracts, bundled into derivatives, and flipped for profit. In other words, energy wouldn't be infrastructure anymore. It would be finance. This belief aligned perfectly with the political mood of the time. The late 1880s and early 1990s were the golden age of deregulation. Airlines, telecoms, and financial markets were being freed. Energy was next, and Enron was perfectly positioned to exploit it. As regulation loosened, Enron stopped thinking of itself as a pipeline company and started imagining itself something much bigger. But imagination alone doesn't move stock prices. For that, Ken Lay needed someone who could sell the vision. Enter Jeff Skilling. Jeff Skilling was a former McKinsey consultant with an almost religious faith in markets, models, and his own intelligence. He spoke fast, he thought faster, and he believed deeply that anything could be quantified, optimized, and traded. Skilling didn't see Enron as a company that moved energy. He saw Enron as a company that moved risk. Under Skilling's influence, Enron began to rebrand itself, not publicly at first, but internally. Employees were encouraged to stop thinking like engineers and start thinking like traders. The goal was no longer stability, the goal was velocity. Skilling's core pitch was deceptively simple. We are not an energy company. We are a technology company. We don't sell energy. We sell the future of energy. Wall Street loved it, because Wall Street doesn't reward boring reliability. It rewards growth stories, and Enron had just reinvented itself as one. The marketplace that changed everything. The real turning point came with the launch of Enron Online. This was a digital trading platform where energy contracts could be bought and sold instantly. Before this, energy trading was slow, opaque, and fragmented. Enron Online made it fast, centralized, and frictionless. Click a button, move millions. To investors, this looked revolutionary. To analysts, it looked like Enron had built the Bloomberg terminal of energy. Suddenly, Enron wasn't competing with pipeline companies. It was competing with Wall Street itself. The stock reacted accordingly. Enron's valuation surged. The company became a market darling. Media coverage exploded. Fortune magazine crowned Enron most innovative company in America 6 years in a row. Inside Enron headquarters, the culture shifted dramatically. This was no longer a utility. This was a pressure cooker. The culture of the smartest guys in the room. Jeff Skilling told employees they were the smartest people in the room. This was not a compliment, it was a threat. Enron adopted a brutal internal ranking system. Employees were evaluated constantly. The bottom performers were fired every year, regardless of circumstances. Loyalty meant nothing. Results meant everything. Bonuses were massive. Competition was ruthless. Backstabbing was normal. Every quarter was a test. Every deal was a performance. Every presentation was designed to impress investors, not reflect reality. From the outside, Enron looked unstoppable. From the inside, it was exhausting. And beneath the surface, the numbers were starting to crack. The mask, how the illusion was built. By the late 1990s, Enron's stock price had gone from $7 to over $90 in just 3 years. That's more than 1,000% growth. If you bought Enron instead of groceries, you looked like a genius. Executives called it success. The media called it a miracle. But miracles require faith, and faith doesn't ask questions. Enron had promised constant growth, no bad quarters, ever. But energy markets don't behave like tech startups. Prices fluctuate, demand shifts, reality interferes. So Enron solved the problem the easiest way possible. They changed the rules. Mark to market, profit from the future. Enron adopted mark-to-market accounting. On paper, this method was legal. In practice, it was a loaded weapon. Here's how it worked. If Enron signed a 10-year energy contract, instead of waiting 10 years to collect profits, the company would estimate how much money it expected to make over the entire contract and book it all immediately, today. The future became revenue. The problem, those profits were guesses. Optimistic guesses, sometimes absurd guesses. Deals that hadn't even started were counted as massive successes. Projects that were already failing were still reported as profitable. And once future profits were booked, they could never be adjusted downward without admitting failure. Internally, chaos grew. Externally, everything looked perfect. And when reality threatened the illusion, Enron didn't course correct. It doubled down. Andy Fastow and financial storytelling. Enter Andy Fastow, Enron's chief financial officer. Fastow's job was not to fix the business, it was to protect the image. He created dozens of special purpose entities, SPEs. These were technically separate companies designed to hold Enron's bad assets and hide losses. In theory, this was allowed if the entities were truly independent. In reality, they were anything but. Enron funded them, Enron controlled them, Enron guaranteed their losses. It was circular financing disguised as risk management. Enron would sell failing assets to an SPE, book the transaction as revenue, and claim the problem was solved. But the money used to buy the assets came from Enron itself. It was accounting theater, and Wall Street applauded. Who paid the price? While executives cashed out millions in bonuses, employees were encouraged, sometimes pressured, to put their retirement savings into Enron stock. Their 401k plans were heavily concentrated in company shares. Selling was discouraged. Loyalty was praised. Analysts continued issuing buy ratings. Many worked for banks doing lucrative business with Enron. Objectivity was optional. Revenue was not. Auditors, regulators, and investors all sought pieces of the puzzle. No one assembled it, because asking hard questions would have threatened the party. The cracks appeared. In August 2001, Jeff Skilling abruptly resigned as CEO. No explanation, no warning. It should have set off alarms. Instead, the company told investors everything was fine. That same August, the SEC launched an investigation into Enron's off-balance sheet entities. Internally, a vice president named Sharon Watkins mentioned that Enron could implode in a wave of accounting scandals. The response was not reform, it was damage control. Collapse. In October 2001, Enron admitted to accounting errors. Nearly $600 million in earnings vanished. The stock collapsed, from $70 to under $1 in 4 months. Employees watched helplessly as their savings disappeared. Executives sold stock. Bankruptcy followed. On December 2, 2001, Enron filed for bankruptcy, the largest corporate collapse in American history at the time. The fallout. Arthur Andersen, Enron's auditor, found to have shredded evidence. The company collapsed. Tens of